Hello and welcome to Alternative Designs June product launch. I'm Tim Harding, Chief Marketing Officer for Alternative Design, and thanks once again for taking the time to join us today. We've got some good stuff for the month of June. We had an excellent May. Thank you very much for your business. We appreciate it. Looks like we're kicking off summer in style here. And June has some very good products on our platform. A couple of twists, a couple of tweaks here and there, but I think all to the better. Lots of maybe small appearing, but I think significant improvements to a number of products on our portfolio for the month of June. So once again, we're offering 6 different products for the month of June from 3 different banks. We'll have the Bank of the West Commodities Income Advantage product, which is very popular. We'll have a Barclays 7-year equity-linked product that'll pay a 2% commission. The Bank of the West product at 2.5%. Then we'll also have the Bank of the West Equity Income Advantage product paying 2.5% commission. And then a Barclays 6-year product that has some interesting twists to it. I think you're really going to like that. Pays a 2% commission. The Goldman Sachs Momentum Builder product, another 2% commission, and the J.P. Morgan High Yield Bond Linked product, which was very popular last month as well. That will be paying a 2% commission. So want to jump right into these. So let's go first of all to our single commodities linked CD for the month of June. It looks pretty much like it has for the last several months. Bank of the West is the issuing bank, of course, a wholly owned subsidiary of BNP Paribas, the world's largest bank, well, depending on what day of the week it is. It's a 7-year commodity-linked product called the Income Advantage. It's what I call an either-or product. It has a minimum guaranteed rate of 1% or a maximum of 7.25% and nothing in between. It's linked to 5 sub-indices of the S&P GSCI Commodities Index. I think these are the same 5 as last month and the month before. Cocoa, coffee, corn, lead, and natural gas. And the way the Income Advantage products work is very simple. On the calculation date, or what we would in the insurance industry refer to as the anniversary date, if all 5 of these commodity indices are equal to or greater than their initial share price, the initial price when the offering closed, then the client receives the maximum of 7.25%. If one or more of those commodities are negative from that initial share price, the client instead receives the minimum guarantee of 1%. Either or, nothing in between, no averaging. If the commodities are all positive, you get the maximum of 7.25. If one or more is negative from the initial share price, the client will receive the minimum guarantee of 1%. And you know, if you sit down and you play with the math a little bit on these Income Advantage products, you don't have to hit that maximum very often for you to have a really tremendous return. And remember, you're looking at a 7-year period here. So the probabilities that your client is going to hit that maximum just increases the longer that the product is held. So towards the end, there should be some very handsome returns. And in the meantime, worst case scenario is still more than competitive with a traditional certificate of deposit. On the equity side, we have several offerings this month. We'll start with Bank of the West, since that's where we've been in the commodities world. This is the commodities version of the Income Advantage, or the equity version of the Income Advantage product. Slightly different numbers, a minimum guarantee of 1%, a maximum on this product of 7%. So not quite as much upside, but pretty close. Linked to 5 individual stocks. And those have changed a little bit from last month's offering. Apple is still in there. Bristol-Myers Squibb is a repeat, so is McDonald's. Actually, so is PPL Corp. But now Verizon is in this particular offering. I believe last month it was AT&T instead of Verizon. So pretty much the same economic sectors here, the same market sectors. And once again, for the client to receive the maximum of 7%, all of those stocks have to be equal to or greater than their initial share price on the anniversary date. If one or more of them is negative, the client receives the minimum guarantee of 1%. Once again, either or, nothing in between, no averaging. If none of the stocks is negative, the client gets the 7%. If one or more is negative, the client will receive the minimum guarantee that year of 1%. And again, do the math. You just hit that 7% a couple of times, and you've got an FDIC-insured, principal-protected, and guaranteed product that has a very, very nice rate of return. We have some offerings from Barclays this month. First of all, we have a 7-year equity-linked product linked to a basket of 10 stocks. Has a 1.35% minimum annual guarantee, minimum interest payment of 1.35%, regardless of the performance of the stocks in the basket. That's down a little bit. I believe it was 1.5 last month, but 1.35 minimum guarantee is still going to be one of the highest guarantees that you can find. Has a 5% auto cap feature on it, and this is really important. I really can't overemphasize enough that it has a minus 10% return floor, and I'll talk a little bit about what that means, but that has a major impact on the total return of the product. The 10 stocks in Barclays basket is Apple, American Express, ConocoPhillips, Ford Motor Company, PPL is in there, AbbVie is in there, Bristol-Myers Squibb Company is another one. I guess these bankers are all thinking the same. Cisco Systems, Microsoft, and Williams Company. So some names that your clients and prospects will recognize. Just a quick review on how the auto cap calculation works is this right here. What the auto cap says is that when we average the return of each of the 10 individual stocks in the basket, if an individual stock is equal to or greater than its initial share price, the client's automatically going to be credited with the cap. On this product, it's 5%, for purposes of averaging those 10 stocks. And if a stock goes down, the negative 10% floor says that even if the stock goes down 40, 50%, for purposes of calculating the average, it cannot count more than a negative 10%, regardless of how far it's gone down. That floor or safety net or stop loss, whatever you want to call it, is critical if you have a stock that tanks. Because I've seen products, and perhaps unfortunately you have too, where one or two stocks take a big nosedive and it just drags the yield down on the CD for pretty much the duration. That can't happen in this product because it can't count more than a negative 10%. And you've got the auto cap feature on the upside. So this slide is a quick review of how the auto cap calculation takes place, basically in 3 steps. On the calculation date, or what we would call the anniversary date, you compare the initial share price to the current share price for each of the individual stocks or commodities. If the share price is negative, we credit the component with the negative, but not lower than the floor. On the Barclays product, it's minus 10. If the share price difference is not negative, meaning it's equal to or greater than its initial share price, then we credit each of those stocks with the cap. We add up all those share price differences, positives and negatives, caps and negatives, and then divide that total by the number of shares, and that would calculate the interest payment for that particular year. Nice feature. If you're not familiar with the auto cap, a couple of things you can do. There is a consumer support video on our website, which you might want to review from time to time because it goes into it in more detail than I have time to today. Or better yet, give your business consultant a call and have them walk you through it. This is a very nice feature and actually puts a fair amount of sizzle into your sale, because if the stock goes up even 1% on this product, the client's going to get credited with 5 for purposes of calculating the average. So the auto cap can really be an advantage to your client under certain market conditions. We have a new product from Barclays. Looks a lot like the Bank of the West product. It's a 6-year equity income advantage type of product. Minimum of 1%, maximum of 5%. The big difference here is that it's a 6-year product, not a 7-year product. It's also linked to a basket of 5 individual stocks, just like the Bank of the West product is. The basket components for Barclays are Apple, Duke Energy, Hewlett-Packard, Nike, and Ford Motor Company. And if you go through the Barclays offering documents, you'll find some examples there of how the either-or works. And I think they're useful in walking through the program with your clients. This is a cutout from one of those term sheets. And if you look in the first column, the question is the closing price of any basket component less than its initial price? Well, under number 1, if the answer is no, then the client's going to be credited with the maximum of 6.5% on this product. In year 2, we see the answer to the question, is the closing price of any basket component less than its initial price? In year 2, the answer is yes, so the client receives the minimum guaranteed rate of 1%, and so forth and so on. So really that question, is any closing price of the basket less than its initial price, yes or no, determines the either-or interest payout on all of the income advantage products. Now, an area that I've been real excited in, and I've talked about it a number of different places, is how progressive the indexing strategies have been from the banks recently. And I talk a lot about how these are dynamic indices as opposed to passive indices. And so take a close look at these. I mean, I know that you have a lot of experience with products tied to the S&P 500 and so forth, but those broad market indices are really like getting on a raft and going down the river. You're going to go wherever the current takes you. Your returns are going to be, only what the market is willing to give you, whereas these MLCD indices tend to be dynamic, and they respond to economic conditions, and they make changes in the index in response to those economic triggers. The first one we have is from J.P. Morgan Chase. It's a 7-year variable income CD, minimum annual interest rate of 0.75%. Those of you who take a look at this product will see that last month's offering did not have that minimum guarantee. Annual minimum guarantee of 0.75%, and it's linked to the J.P. Morgan High Yield ETF Volatility Index. And of course that index has no cap and is tied to the PIMCO 0 to 5 year High Yield Corporate Bond Index ETF. But the way this index works, the way that it's dynamic, is that it has a volatility control on it. If the volatility in that index is 3% or less, then the product is 100% exposed to that ETF. But if volatility exceeds 3%, then the exposure is reduced. What this does is it gives you the ability to have a much more steady rate of return. You can see the red line here is the PIMCO. The High Yield ETF Volatility Target Index is the green one in the middle, and then Barclays Aggregate Bond Index is the gold-colored one on the bottom. And you can see that there's less movement, less volatility in the High Yield ETF Volatility Target 3% Index. Goldman Sachs has another great index that I think you should take a very, very close look at. It's called the Momentum Builder. This product is a 7-year annualized point-to-point product. I'll explain what I mean by annualized point-to-point. It's multi-asset linked, 100% participation rate with no cap, and it also pays an annual interest rate of 0.75% minimum. So in the past, a lot of these index-linked products were, like 7-year point-to-point. Now they're going to calculate interest on an annual basis and, regardless of the performance of the index, pay a minimum guaranteed amount. Now, I said that this is a multi-asset product. It's designed to cross over through several different asset classes. They select from a variety of asset classes, a variety of ETFs that I'm going to show you in just a moment. And then this index, like I said, is dynamic. It's rebalanced each month, and the volatility is managed on a daily basis. So here are the 7 asset classes that this particular product is linked to. So if you have a client or a prospect who isn't sure, like most of us are, what the market's going to do over the next 5 to 7 years, isn't sure whether commodities are going to bounce back really strong, doesn't know what the right portfolio mix should be, this might be the market-linked CD for them, because you can see that the link in this particular product is going to be over 7 different asset classes. Money market, developed equity market, where you've got some S&P 500 exposure as well as some exposure in Japan. You've got U.S. bonds, emerging markets, alternatives, including real estate and a senior loan portfolio, commodities, and then inflation-linked U.S. bonds, an ETF that tracks the TIPS government bonds. And so you can see that there's an opportunity here to give your client an all-in-one diversified portfolio across 7 different broad asset classes. And you can see, if you compare the performance of this particular index, and by the way, since day one, many of you have been asking for historical performance, and for the most part, the banks will not provide that because each and every offering is different. But on these indices that are mathematically based as opposed to actively managed by a human being, you can actually back test and see what the performance would be. And you can see that over time here, since 2005 through roughly January of 2014, that red line in the center shows very little volatility and steady growth. And that's exactly what you would expect of a well-diversified portfolio with several different asset classes. A street vendor in New York City probably has umbrellas and sunglasses for sale at their stand. Now, you know what? When they're selling sunglasses, they're unlikely to be selling umbrellas. But when they're selling umbrellas, they're unlikely to be selling sunglasses. So what you have when you have a balanced portfolio is an opportunity to earn well regardless of current economic conditions. And you can see that this multi-asset fund has outperformed virtually all, not 100% all, but most of the individual asset classes that it contains. The returns on this product just blew me away. And again, because you can back test on this, because it's mathematically based, we can see what the returns on this particular index would have been. So if you go back to 2003, which is down on the very bottom, and then go all the way over to the right-hand column, which is the annual return for 2003, 22.47%. Very high. 8.03, 2.75, 6.93, 5.34. We've got a negative in 2008, but look at that. It's a negative 1.54. What did the market lose in 2008? 2009, it's up again, 7.51, 9.60, 9.13, 8.14, 4.13. Folks, this is something to get excited about. An FDIC-insured product with the potential for double-digit returns. I mean, this is a mutual fund killer. Diversified across 7 different asset classes? Wow. This is one of my favorites. Both of these index products utilize what I refer to as annualized point-to-point calculation. And what it does is it takes the initial share price and then takes the gain in the index and divides it by the number of years that the product has been in existence. So if it, well, here's an example. You can see on the first coupon determination date, the index level was 119.60. There was a total return of 4%. And so that's in the first year. So what they're calling the index factor is really the number of years. So we divide 4 by 1. We get the cumulative return and the coupon payment of 4%. Second year, the total return is up to 8%. That's where the index is at the end of the second year compared to the initial share price. But it's in the second year, so we divide that 8% gain by 2, and we get 4 again. So 4% is the coupon payment. Third year, it's up to 12, but it's the end of the third year, so we divide the 12% by 3. We get another 4% interest payment that year. Fourth year, the index has fallen back some, and it's only up 7% from the initial share price. We divide it by 4 because we're in the fourth year. The interest payment that year would be 1.75. And so you can see through the illustration that this is really just an annualized point-to-point. We're going to measure the beginning point to the end point and divide by the number of years that product has been in place. I talk all the time about the advantages of the indexed CDs because they are dynamic as opposed to passive. Usually they're linked to a proprietary index with a very specific strategy, guaranteed return of principal, no fees, and of course the added security of FDIC insurance. Now, you've long been able to call yourselves safe money professionals and put your clients into principal protected products, and market-linked CDs are no different. But now with these advanced indices, with the different asset classes that you have available to you, you really have the ability to, for the first time, plan out an asset allocation strategy with your clients and cover different asset classes like commodities, stocks, and bonds, all with the added safety and protection of FDIC insurance. I think you've got a huge opportunity here to differentiate yourself from the crowd of those people who can only offer a passive response in the form of a market link. So with that, as always, I'm happy to take questions here at the end of the presentation. I'll handle as many as I possibly can. It looks like there are a few that have been typed into the chat box already. If you have questions and you haven't done so already, please feel free to go to the chat box on your control panel and type in any questions that you have, and I will answer as many of them as I can get to. And of course, you can always call your business consultant here at Alternative Design for a detailed discussion of your questions or how to position the product and place it. See, David says, there have been rumors of the Fed having negative interest in the near future. How would that affect MLCDs, guaranteed interest rates, and possible growth if it happens? Which of the CDs might have gains because of it? David, that's, let me read that question again. There have been rumors of negative interest in the near future. That's probably a discussion to have offline, David. I think that the detailed answer will be more involved in that. Rick asks, is the multi-asset product a point-to-point product? It's what I call annualized point-to-point, Rick. You measure at the end of each year from the initial share price and divide by the number of years that you're into the product. So it is a form of point-to-point, but pays an annualized interest rate. Okay, well, don't see any further questions at this point. Thank you so much for joining us again. We'll be back next week, same time, same place, Wednesday afternoon, 11:35 Pacific time. Have a great week.